Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, March 4th, just after the close. And I was waiting for that bell to come, tell you the truth. It's been one of those grind weeks, a lot of pressure on the market. Don't have to discuss what's in the news every day. We see really the dual concern of higher rates from the Fed, which, to tell you the truth, I think has gotten priced in, and now most attention turns to Russia-Ukraine. Boy, it was a bloodbath in Europe today. You saw France down 5%, Germany down 5%. Real pressure coming in terms of some of the developments, the further developments that we're seeing. Anytime you hear the word nuclear mentioned in terms of the plant in Ukraine or Putin talking about what's on the table, you're going to get panic. And the key when you get that kind of panic is to lean into what we talk about an awful lot on these videos. And that is what can go right and what can go wrong. And if you can't look at markets that way, you're going to tend to be a victim of greed on the upside. You know, some people call it FOMO, fear of missing out, greed, chasing, and you're going to be a victim of fear on the downside. That's what we're trying to avoid, those two extremes. And I'll give you an example. In tactical trend today, we sold half of our ACWX position. That's just the All-Country World Index position. It's an international position. It was our only international holding, but when it couldn't hold $50, you know, 50 to 51 from January, we had to pare back half of it. That discipline wasn't easy. It feels overdone in that security, but it was still necessary to pare back that position because we don't know what can go wrong. Let me give you an example of what can possibly go right in Russia and Ukraine and how we prepare for that. Our other trade today happened to be in tactical trend again. We sold nearly half of our XME position, our S&P metals and miners position. Why? We have a 40% move in 4 or 5 weeks in a commodity-based equity basket that you have to trade. Having traded in multiple asset classes for, you know, the last 25, close to 30 years, I hate to say, I have had drilled into me from the beginning of my trading career that commodities are meant to be traded versus invested in. When I get that kind of move, and we have a chart to take a look at one specific number that I keep a close eye on. When I get that kind of move in a commodity-based position, whether it's an outright commodity or an equity, obviously linked to the commodity industry, I usually tend to take positions down on strength. You'll notice the highlighted distribution number, 131%. What that means is the positive weekly momentum in the metals and miners ETF had reached 131%. Once the number starts to crack 100, 105, 110 on the weekly momentum, which is just a 1-week view versus a 10-week, you're in a very overbought area. When we hit 131, and that number, by the way, is before today's action, and this security was up another 2%, we're going to be closer to 140, including today's action. The market is forcing me to sell a little into that strength. And that's the flip side of what can go wrong. What can go wrong is why we sold some ACWX. Europe can continue to flounder. As nasty as things are in Russia and Europe, they can elevate from here. What can go right? You can get some conversations. You can get a brokered conversation and you start taking steps towards some type of resolution. Very difficult to imagine what that resolution would be right now, but that's how you have to trade and invest. So while we took a look at what could go wrong and lightened up on the international basket, we also had to respect the fact that if anything positive came over the weekend, these metals, miners, and commodities would be down 6, 8, 10% Monday morning. GSG, which is a basket, and you can look that up, it's a Goldman Sachs commodities basket. The weekly positive momentum has cracked 200 on the upside. I was mentioning to our portfolio managers and advisors today, I can think of less than 5 times in my career that an asset class cracked 200% positive momentum, having done that in less than a month. Shocking strength. Almost forcing you to sell something into that. If you're chasing that, and I got calls this week about buying oil, buying gas, buying metals, buying commodities. You made some money this week. The real money has probably, short term, been made. Be very careful if you're late to that party at some of the extreme readings we're getting. So just a couple of things we go over day to day, week to week, month to month. That leaves us at about 23, 24, 25% cash and tactical. That's okay. Don't love holding cash, but what that gives us is flexibility to look for opportunities. Nothing wrong with that in a volatile market. Been stressing that it's important to be patient in these markets. So far, we're able to pick our shots here and there, and this cash will be handy. Have a great weekend. We'll be back next Friday. Dr. Leo Chen will be with me next Friday. And don't forget to subscribe in case we have a midweek conversation about markets or anything that's happening overseas. Enjoy the weekend.
Hi, I'm Patty Healy, Senior Vice President of Research at Cumberland Advisors. Today is March 4th in the evening, early evening. It was quite a week. A lot of very bad news from the invasion of the Ukraine to talk of nuclear options, killing of women and children. It was just a bad week. And what happened was that there was a flight to quality. Treasury yields went down 20 basis points for the 10-year to a 174 and 10 basis points on the 30-year to a 216. Corporate bonds, muni bonds, taxable muni bonds were all off a bit. They did not perform as well. Rates were higher in those sectors, but not much. All this bad news and people being fixated on the war, as they should be, were overshadowed a really positive non-farm payrolls report. There were expectations that employment or non-farm payrolls would increase by 423,000. Meanwhile, it came in at 678,000, and it was very broad-based in most sectors, including government. And the unemployment rate went down to 3.8% from 4%. And it seemed like wages did not go up as much as was anticipated, thinking maybe that would put some inflation fears behind us. Of course, we've got other things to worry about. Next week, we're going to hear about CPI, another measure of inflation. It's expected to be up 7.9%. Last month, it was 7.5%, and people thought that was high. If it comes in lower, we'll see what happens. Even month over month is supposed to be up 0.8%. So the Fed takes that into consideration. The Fed takes what's going on in the Ukraine into consideration. It takes into supply chain disruptions of what's going on, price of oil, employment, CPI, PCE, their preferred inflation measure, and they're going to take all that information and put it together, and we're going to see what kind of rate increase they come up with in March. So there are guesses across the board for that, and so we'll see what happens. And finally this week, I have a chart to show you from a call that I was on this week with Municipal Market Analytics, showing that the 10-year Muni Index area total return has only been negative in 3 of the past 40 years. Now it's negative this year, but that's only year to date, so we'll see what happens. But it does go to show somewhat of the stability of returns in the muni market. So I hope you enjoy, and again, if you have any comments or questions, we look forward to it, and have a great weekend. Bye.